Well, good morning or good afternoon, wherever you are coming from. How's everybody doing? Let me know if you would that you can hear me loud and clear. I don't know if it's being recorded. I didn't hear that yet. So if it hasn't, Andrew, hit that if you would. Maybe I just missed it. I did get in a little bit late. Hello, Kevin. Awesome. Thank you, Andrew. Hello, is it Rena? Hopefully I'm pronouncing that right. If not, correct me. I have no problem with being corrected about anything. You trade long enough and you'll find out the market does not care about your feelings. Okay, good. The market will beat you upside one down, then down the other, however that saying goes. Um, but at the same time, we keep coming back for more, right? Because it's fun. Trading's fun, but it's also tiring and can be exhausting. It depends on if you're on the right side or the wrong side. If you're on the right side, it's exuberating, right? It's like, ah. But if you're on the wrong side, it's like, ah. And you're going to have you should have realistically a fairly even mix of both. Um, Thank you, Brenda. I just noticed that myself too. There we go. I got to figure out the new background thing. I haven't when I upgraded this machine, it somehow got rid of it. But yeah, trading's it's a lot of fun, but it's also tiring. I see people, new traders that are on, and they're posting and saying, "Oh, it's I can't believe the market's closed on a weekend. It stinks. I can't wait till Monday." And it's like after you trade long enough, I mean, 20. I'm on almost 26 years now. You get to a point where it's like, all right, where's the weekend? And you want the weekend to be there because it's like you want to get away from it because it's not that it's I wouldn't call it stressful, but it's an emotional roller coaster ride, right? And it could be stressful depending on how you manage stress and how you handle the stress of the market and trading. But it's definitely an emotional roller coaster ride. So, and you'll have great days, great weeks, great months, and you'll have the same thing on the other side. You'll have bad days, bad weeks, bad months. And if you're in a drawdown period, if you're in a period where things are you're giving some back, right? Because you're not just gonna have a linear growth line. Your account should hopefully it looks like a bullish trending stock, right? You go up some, you make a bunch, then you give a little bit back, then you make some more, then you give a little back. That's the goal. Most traders end up either just flatlining or heading south. So I think a big part of it took me a while to figure that out because we all want that linear, just straight line growth. Like, you turn 20 grand into 20 million in 3 days and right off into the sunset and everybody's happy, right? It's just not reality. So sometimes it's good to rein yourself back in and make sure that you're not getting off into crazy land in your mind. So it's easy to do that. So, but let's get this out of the way. I am not a registered broker dealer investment advisor. I'm not going to give you any recommendations or advice. Everything we do here is purely for educational purposes. So if I do happen to mention a trade or a practice, or just assume it is a paper trade or practice trade. For regulatory reasons, we do not discuss funded trading here. So Happy New Year, by the way. Hello, Brenda. Um, Hopefully, y'all had a good Christmas and a good New Year. Mine was relatively low key. My neighbor's, well, his wife's Venezuelan, and if you're familiar with the Latin community, they love to party, love to party, and I don't mind because it's right across the street, so I don't have to drive anywhere. So I go over there and have some drinks and party, and they all dance, and I'm like, nah, I'm not much of an answer. So, happy birthday today or yesterday? Are you your New Year's maybe? So we had a good time. Just walk across the street. I didn't get too crazy this year. I didn't even fall asleep. Uh, so which is what I usually do. Thanksgiving, especially because the turkey and usually have a few drinks, and so eat all that food and then lay down on the couch to relax and unwind and all this. Next thing you know, I'm out. And she loves taking pictures of me and laughing at it. So, but this Thanksgiving and Christmas, neither one of them did I fall asleep. Another guy fell asleep the other night though on New Year's. So it was fun to get to poke fun at somebody besides me. So, but I'm up at 4 or 5 in the morning because market opens 6:30 on the West Coast. So I get up early and I work a lot. So there's all the social media platforms you can find us on. And if we haven't met, there is the few tools that I have, Patterns and Flash, which is all about technical analysis, right? So if you want to, sorry, something in my if you're even if you're not new to technical analysis, if you want to learn to recognize the patterns on the right side of the chart and know what to do with them when you see them, and even just some of the basic, core, most important technical analysis stuff that we use is all in patterns of flash. There's about 6 to 8 hours of video in there. It's all on demand, right? So you can use it. You can watch it on your phone while you're driving. Well, not while you're driving, but you can listen while you're driving. Don't watch. Um, Work wherever. But and then there's flashcards. That was the whole point of it. Is because when I first started, the challenge I had was recognizing the patterns on the right side of the chart. I started in 2000. It was April 3rd and 4th of 2000 when I first found myself sitting in a workshop. I'm like, wow, this stuff's awesome. And I just dove in head first, started reading about technical analysis, and I saw the power the patterns could have in their predictability, their reliability, their predictability, and their consistency. Right? They don't. It doesn't happen all the time. Nothing's 100%. Well, death and taxes, right? But what I realized is that they could give me an advantage. And so I read about all the patterns. And then I started looking for them in the charts and I'd find them, but I'd find them in the middle of the chart, which does nothing, right? You can't do anything with it if it's in the middle of the chart and the pattern's already played out. You need to see it on the right side. Um, so, being the son of a teacher, grade school teacher, flashcards were something that was common that we used not only as a kid, but I watched my mom use it with her students, right? So, all of a sudden one day I'm like, if I create flashcards to train my eyes to see the patterns on the right side of the chart, that should work. Just like 2 + 4 is 6, right? Now you don't even think about it. Your brain doesn't turn on. And if you do that enough, then you'll get to a point when you look at a chart, you'll just see the pattern automatically. It'll literally just jump off the screen at you. You don't even have to work at it. It's just automatic. That was the whole purpose of patterns of flash, which is what it does. That's why there's been at least a couple thousand people have utilized it. So, not sure. Does everybody have a screen? Ed's saying he's got no screen. I'm not sure why. Open your eyes, Ed. I'm just kidding. Uh, okay, good. Because yeah, on my side, it'll show me what you guys are seeing as well, and I always have that running, so I know that you guys are seeing the same thing I'm seeing. So I'm not sure what's on your end, Ed. Maybe try logging out, logging back in. That might work. Sometimes it does. Or if there's something that's not turned on, I'm not sure what's going on there, but well, it looks like that's what you're gonna do. All right, and Weekly Whispers is something I started doing a couple years ago. I said, you know what? I'm already doing all this research for my own trading. Why not just record an audio video session like we're doing now, and show you what I'm looking at and all my candidates. I usually I do my research once a week. It takes 3 to 4 hours, sometimes five, depending on how many candidates I have. So I did it every day for a very short time, but it's too much. And they don't things don't change that quickly from day to day. So I just do it once a week. So I go spend 3 to 5 hours doing my research, finding my candidates. I usually have between 20 and 30 candidates. I told Rob one day, I was like, why not just I can just record this and then people can see what I'm looking at. Awesome. Thanks, Ed. Um, then you can see the trades I'm looking at for the next week, the trading plan, what I'm seeing, the analysis I have. So you can improve your technical analysis skills and have some candidates for the week. So, and then small accounts, big return is something, I guess it's been 2 or 3 years ago since I did this, but if you're working with a smaller account, there are some little tweaks, little things that you can do that will help you grow it to a bigger account. I mean, it's kind of the same no matter what size your account is, but when it's small, you have to adjust things a little bit just because of the size, right? And today you can get started a lot easier than when I started in 2000. The biggest reason is commissions. When I started, the lowest commission I could find was 75 bucks per trade. Plus, if you went over 10 contracts, it was, I think, 250 per contract for an options trade. And I see people now squabbling over commissions. It's like unless you're actively day trading, like in and out scalping or something, doing like dozens or dozens of trades every month or hundreds of trades a month, the commissions are really inconsequential to me. They are because, like I said, they were 75 bucks when I started. And when you start with $1,000 like I did, you pay 75 bucks just to get into a trade. You need a huge move just to get break even because you're paying 75 bucks to get out too. So I blew up my first account in a whopping 2 months. I did 2 trades and they both expired worthless. So that was a fun experience. So I said, hey, let's keep doing this. Let's see how long I can go do this. But that has changed over a 25-year period. So But there's not any traders that I know of that haven't at least once blown up an account. Because a lot of us say you don't have multiple accounts. I've got I think three accounts now. Um, some are retirement accounts and different type of retirement accounts. I haven't blown those up, but I haven't blown one up for years actually. I think I've done it two or three times. And when they're little, it's harder when they're little, right? Because you need bigger moves to make up for the expenses, even though they're relatively minor. But trading is challenging, that's for sure. That's one thing. If you haven't figured that out yet, it is one of the most challenging things you will ever attempt to do, in my opinion. So, and some people don't like to hear that, but that's the reality of it. So, if you've been told or somehow bought into this idea that it's easy and you're going to get rich really fast, that's not likely. It does happen on occasion to some people, but the vast majority of people that I know of that have done that have taken and gotten into just the right market at just the right time and just they catapulted and shot off to the moon. I don't know a single one of them that kept it all. Everyone that I've met over the years has given it all back to the market. So the key is not how much you can make, how quickly you can make. The key is can you do it consistently and can you hold on to your gains? Can you capitalize on those and keep those in your account and steadily grow your account? Consistency is the key. And one thing that took me a long time, little nugget if you haven't heard this, it took me a long time to figure out that the most important piece that I needed to control, really the only thing I had control over was my risk. And when I shifted from looking at and trying to see how much profit I could make, and my focus wasn't really that heavy on the risk. I looked at the risk, I would have stops, but it wasn't focused on it. I was always focused on what I could make. And I wasn't doing that well. And when I shifted to focusing on risk and keeping my risk, managing my risk, and keeping it as low as possible, and capital preservation, right, which is what risk essentially is, preserve your capital. Because the one thing you have control over is your risk. The one thing you don't have control over is how much you might make. We don't know what the market's going to do. Is it going to go up or down? And if it moves in your favor, you don't know how far it's going to move in your favor. And you might just get out too early. Like I had one a couple weeks ago. I was cranky about it. Just last 2 weeks ago, I got out 30%, 25, 30, 35% profit. It had run a bunch. I was like, all right, I think it's probably going to at least slow down or pull back. I can't remember. It was SLV. It was a silver thing. I was cranky because silver had run like crazy. If you pay attention to metals, silver went crazy. So I sold this thing at like 450, 485 or something like that. They were only three. It was a long-term out of the money option. So the delta wasn't very high. So the fact that it moved 30 or 40%, the stock itself had moved quite a bit. And then when it bolted to $70 the other day, I'm like, it was the things were $11. I sold them for $4. I was going to wait for it to pull back and then re-enter it because I figured it would pull back. It looked like it would. The odds were it was going to pull back, but it didn't. It just kept going. I'm like, ah! I literally left like a 250, 300% trade on the table and made a whopping like 30%. I'm like, woo, we'll take 30% a solid trade, right? For a week or two. That's all I was in it. I think I was in it for 2 weeks is all. But then when you see, double the amount left on the table, it's like, that's the aggravating part of trading. That's the frustrating part of trading. So, but it's going to happen, and there's ways to deal with that. But if you will focus 90% of your energy on your risk and how much risk you're taking and asking yourself the question, this is where I finally got to after, I don't know, 15, 20 years was, am I comfortable with the risk I'm taking in this trade? And if you can't answer that yes, you shouldn't be in the trade. Or you should adjust the trade size so it is comfortable. Maybe you have, okay, I'm going to risk $1,000 here. That's too much. I only want to risk 500. Well, cut the size in half then. If everything else you have, if you have a solid plan and it looks like the stock's going to do this and you think it's going to do this, and here's your risk reward, and here's how much I'm probably going to lose if it goes against me, barring a gap, of course, right? And the number's too high, then what number is comfortable? And then adjust the trade according to that, right? So, but let's get to the topic. Preview what to expect this year. We're going to look at three main things: cycles, real estate, and the Fed. There's a ton more that we could look at, but we only have an hour. So I tried to look at what are the biggest drivers, what are the biggest components, or what are the biggest things that, from a macro perspective, that could have an impact on what is going on with the market this year. So cycles is one, and real estate is huge, right? It's what 18 or 20% of the economy, and then the Fed, which is what the market's really been paying attention to the last couple of years. Is what's the Fed doing? Is the Fed's going to lower a rate, and it's the whole market reacts in a goofy way, in my opinion. But then again, that's people are goofy, me included, right? So cycles. And yeah, it's still only 9 o'clock out here, so I'm on my fourth cup of coffee. Usually I only have three, but I need one more today. So when we look at the big picture, there is a 180 week, about a 3.5 year cycle that over the last 100 years has marked prominent tops and bottoms. And this 180 week cycle, the 3.5 year cycle, suggests possible larger market correction could be in store in 2026, which makes sense. Here's the chart. This is a chart actually from the late 90s, looks like 98 or so, up to about 2012. And you can see that that pink line is the cycle analysis, right? Here's the natural cycle that markets go through. And you can see the S&P tracked it pretty darn closely. When we look at, we'll come to current, go 2016 to 26, the last decade, it's not quite as, it doesn't correlate quite as well. Even though it does, you can see here on the pen thing out. We're in a bull market here, right? And the cycle is headed north. It's a normal cycle, and then it turns over. Cycle turns over, and then eventually you can see that it turned over first. And so the cycle analysis is all based on data, historical data. And then the market turned over and dropped off, right? Just a little bit, not a huge correction, but that's the other thing. I think that it's less dramatic here because this is a what's the opposite of logarithmic? It's not logarithmic. It's is it linear? No, that's not the right word. Whatever it is. Logarithmic scaling, I think, would smooth this out, but they both have to be logarithmic to make it work right. But then the market drops off, not huge. That's about 3,000 to 23, 2,400. So I guess that's about 20%, 25%. And then the cycle analysis, you have the lows of the cycle, and that's the COVID crash right there, which, you can factor it into the analysis, but it's an anomaly, if you will. But then the cycle turned, and the natural 180 week cycle started again to go bullish, and the market followed right along. And then the cycle ended, peaked out, rolled over, and the market rolled over almost right at the same time. And in 22, we had a bear market, right? We dropped off 20, 30%, depending on which index you're looking at. At time, which time the bottom cycle bottomed out. We got a double bottom in the cycle, the market started rallying again. So this is where we're at today, approximately. So we could have if you're looking at this cycle part, we could have a small drawdown and then another possible rally. But odds are, if cycles continue the way they have for the last 100 years, we're going to have a down market for a time. The question is, how long is that time? How long does it last? If it does, it might not. I mean, they don't always. Just like everything, there's not 100% anything. Nobody has a crystal ball. We don't know what's going to happen. There have been, some policy changes that will come into effect that could change the way the cycles. They could shift, right? Sometimes cycles shift by a few months or even years sometimes. Yeah, here's a normal cycle, but we had a 12-month delay in the cycle actually playing out. So maybe we stay really bullish this year, and then in 27 is when the cycle hits and it downdrafts. Never know. But I'm of the opinion that we're going to have, at least in the first part of the year, somewhat of a drawdown. In fact, we were up this morning. The futures were up quite a bit, not a ton, but a pretty significant amount. And then they've sold off. I mean, the Nasdaq's in the red now. It was up. The futures were up 230 just before the open, and it gapped up and rallied, and then it gapped up and rallied for about 15, 20 minutes, then turned over and sold off pretty heavy. Now it's in the red. SPX is just barely. Yeah, it's essentially flat. The Dow and the Russell have bounced back a little bit, but they are They're kind of fighting. In fact, let me just pull that down since I'm on this topic. I'll just bring that down here and show you. So this is the overall markets. This is what I have just up here. It's just a quick glance. The left side is the 5 minute chart. The right side is the daily. Let's see. I got the SPX, the Nasdaq, the Dow, and the Russell. But what I like to look at on here, I mean, I see the intraday movement. Um, and then the 50-day and the 200-day on the daily is what I'm watching because that's where the major trends are. And the SPX is just barely above it. The Nasdaq, if we zoom in a little bit, is sitting right on it. It broke below it, but then got back above it. The question is, can it hold it? If it can't hold the 50-day, then the odds are we're coming down to the 200-day, which is interesting because you've got some tech stuff has been crazy up. I mean, Taiwan Semi is up 12%, 13%. A lot of the semiconductors are up. Nvidia's up. Well, it was up. It is up actually a little bit still. It's up 1.5%, to almost 3 points. But it gapped up and ran for 15, 20 minutes, and then it sold off and it's starting to trail off now. Palantir's getting hammered. Microsoft's getting hammered. Some techs, Amazon's getting hammered, or at least it was, down almost 2%. Microsoft's down 2%. Maybe it's not a hammering yet, but if it keeps going for the day, because we're only halfway through, even if it adds another 1%, a 3 or 4% drop in one day for a big stock is a big deal, right? And Nvidia is the only one of the Mag 7 that's up. Um, yeah, that's interesting, Barry. I just noticed that too. Lost my train of thought. What was I just talking about? The overall market. Let me try to, what was I? Finish this thought. Oh, the Mag 7. Uh, the Mag 7, the last 2 or 3 or 4 weeks has actually been showing some weakness. And the Mag 7 is what has, as most of you probably know, it accounts for about a third of the SPX. So if the SPX is up 20% for the year and a third of that 20% is from the Mag 7, what happens if the Mag 7 turn over? The market itself is going to turn over. And they've been showing weakness in the last few weeks. So that I think is going to drive the overall market. It is, and I've been saying this for a year or two now. It's a stock pickers market. There are sectors that are doing well and other sectors that are not doing well. Uh, some are better than others. So you've got to be very selective. You can't just throw a dart at the wall and play the bullish side and expect to make money, right? In the late 90s, you had that. Even after the real estate crash in 08, 07, 08, 09, 2010, market bottomed out and you could pick just about anything and everything was going up. But we're not in that market. I don't think we're going to be in that kind of market for quite some time, actually. Um, so we'll see. But yeah, I'm not sure. Yeah, I saw that too. It's like that should be, unless this is backdated. This might actually be um because yeah, I think this snapshot is from a few months ago. Some of the data is not really quickly updated, right? It's not real fast. So I think this was actually a snapshot back in the middle of 24 is what it looks like. So we should be right at the end of 25 on this we should be on that vertical line at 25. But the cycle analysis you can cast or project out into the future, right? You can say, okay, here's the cycles, here's what they've done in the past, and here's what they're likely to do. I mean, you can see those cycles are almost identical when you look at the flow of them. They're not always 100% identical, but they're close, and they're similar time frames. So we can say this is what over the last 100 years. Here's what the cycle looks like, and it's like a wave sign or a sine wave, whatever you call those things. I'm not that technical into that stuff. I'm not big into cycles. I think it's good to look at from a major market perspective, from a macro perspective. It's good to know what the major cycles are. Election cycles, that's another thing. The presidential cycle and the election cycles, those are other things that you can pay attention to. I don't look at it real close. I look at it once in a while because, like I said, they don't change. It's not like they change every day. So they're not something we need to keep a constant eye on. But so the expectation is for the cycle to be heading lower this year. So we'll see. But like I say, this is not a major part of my analysis. It's just one thing that you keep in keep feather in the cap, if you will, whatever you want to call it. Yeah, that'll be interesting, Trip. Very interesting. He says, I'm curious to see how the demographic decline and the debt cycle will affect the market this year. It's already having an effect on the rental market. And I mean, I get out, drive around now and then, and I've seen a major increase in for rent signs. Like there's one a few doors down that just went up a month or two ago. Just went out the other day running some errands for Christmas stuff, and there was one road, there was two or three houses, like within about a mile stretch. I saw these for rent signs pop up, and I've seen them elsewhere too. And the one thing in the last 4 to 6 months, the um, rental market has cooled off, where rents are actually coming down now because they were going crazy up because of the demographics. Um, and regardless of how you feel about immigration, when you have 2 or 3 million people that have either left the country voluntarily or have been forcefully removed for whatever reason, then you're going to have a lot of housing open up, which was part of the problem with the whole opening of the border anyway. That's a big part of what created the massive inflation we saw. And people talked about real estate shortages. Well, yeah, when you bring in 10, 15, 20 million people over a relatively short period of time, they need somewhere to live, right? So, I mean, that's just a common sense thing. It's like real estate went up for that reason. Real estate has stayed high for that reason, especially rentals. So, part of the reason we're seeing rents come down now is because of that. The question is what other impact, which obviously that had a major impact on inflation as well. Housing inflation was the biggest part of inflation, if I remember right. Food is still a little bit elevated. Some of it's come down. Some of it's still high. Beef is apparently going higher. Um, so it's kind of hit and miss. Overall, inflation's coming down. Fuel is coming down. It's come down a bunch actually. So that will obviously have an impact on things at the stores. The other part of inflation that is increasing, this is part of the problem when you import that many people and you have housing prices go crazy high and everything else goes high. Everybody's complaining about the insurance. Insurance is crazy. It went up 20% this year. Well, yeah, because the value of your house went up 20%. So the replacement cost, everything else went up. So to replace your cost, it was 250,000 4 years ago. Now it's 500,000. If the insurance company, your house burns down, God forbid, the insurance company now has to shell out $500,000 versus 250 grand. 5 years ago, they only had to shell out 250 to replace your house, or whatever the number. Now it's doubled. So people are like, insurance, you got to fix the insurance problem. Well, you got to fix the inflation problem first. That's the reason it's happened. Once the inflation is taken care of, then it's already stabilized to a large degree. And if housing valuations come down, there's the interesting part. This is one thing I've thought from a trader's perspective because my mind's always in that mode. Are the insurance companies going to lower your rates? If your house, say your house went from 250 to 500, and let's say in a year from now, it drops back to say 350. Replacement cost is 500,000. It's what the insurance raises it up to. And they raise their your premium up to that level to cover that. But what if in a year from now, or 2 years from now, or 3 years from now, what if your replacement cost is only 350? Do you think the insurance company is going to lower their premium to reflect that newer, lower valuation? Probably not. I mean, they might, but I'd say it's probably not likely. Which means what? The insurance companies will be more profitable. If they don't lower your rates, but their costs to replace the houses that do burn down, or whatever claims they have, if those are less expensive, then their profits, their bottom line goes higher. So that might be a trade to watch in the next few months or a year or two, just see how the insurance companies are doing and see if their rates. I'm probably not going to analyze that deep into it to figure it out. I'll just watch the chart, which is what I do. But it's a good macro view to have. Is the insurance companies might get really bullish in the next few months or a year or two, depending on what market conditions are like. For that simple reason that if they don't lower their premiums, then their profit's gonna go up just naturally. So all the crazy weather events to insurance. Yeah, yeah. Well, yeah. Are they weather or are they man-made? It's the question. No, I'm not talking about global warming or climate change or whatever the heck they call it now. Um, well, like the fire in California. Most of that could have been avoided if they would have managed the forests well, if they would have done the things they needed to and had the water they needed to, and not had a bunch of crazy policies that made no sense. If they would have been paying attention and knew that that was a possibility and been prepared for it, probably would have avoided at least half, if not 80% of that. That's what I mean by man-made. It's bad policy. And my dad's a forester. I grew up working in the woods with my dad. And it's like, okay, if you go in and clean out the underbrush, that's the problem with nobody wants to go touch anything in the forest anymore. All the climate freaks want to be like, we can't touch anything. Just got to let it be. Well, that's what happens. In the old days, we didn't manually go in and thin out the forests. Guess what thinned them out? Forest fires. A lightning would strike in the middle when there was, 500 years ago, when there was nobody around on this, or at least not very many people. Lightning was still here. It would strike a tree, start a fire, boom, thin out the forest, done. And it would start over. Now we've populated everything, and it would make sense to go in and clean it all out so that the forest fires aren't as intense. We got everything needed to do it, except for the will. So anyway, um, hey, we had floods here. Don't forget us. I'm just kidding. Well, we did actually a couple weeks ago. It flooded. We had lots of flooding in certain areas over the Green River, and um, so yeah, I don't know what it's like there. I'm nowhere near anything like that. So there were several roads that were shut down. So when I did go out, it was like, I got to drive around this thing because all the flooding. I saw some of it driving by. I was like, wow, some levee broke, and so yeah, did it really? I didn't even watch that yesterday. My actually one of my good friends was there. Oh, you ready for a cat fight? Here you go, Brenda. Or assuming you could hear that. Of course they're going to. I don't think they ever fought when I was live. You guys get out of here. They're not going to come over here, that's for sure. Sorry, Brenda. Anyway, let's get you back to this. Yes, for those of you that don't know me, I'm a crazy cat lady. I'm not really. I just have two. Some lady a couple years ago gave me a Maine Coon for nothing, and I was like, all right. And cats are low maintenance, so if I leave, I don't have to worry about. I don't need to find a sitter or anything like that. My neighbor will come over and check on them, but which is why I have a second one. It's because January I was in San Diego last year at my buddy's house, and he come over and check on her, and this other one was sitting on the porch. Apparently, it was a little kitten. And it ran in the house, and he couldn't find it. That's what he said. That's the story. I don't know how true it is. He may have just gotten it, but she's annoying. She likes to fight the other one, and the Maine Coon doesn't want anything to do with her. So, anyway, getting back to volatility. What can we expect from volatility? Um, Volatility has increased, if you didn't notice that, in some ways, in some arenas, I should say a lot. I mean, gold and silver has gone crazy with volatility, mainly because it's made a huge run, but also the volatility is up. Generally speaking, volatility, when markets get more volatile, that is an indication of the end of a move, whether it's up or down. Generally speaking, we see it more on a bullish. Once we've had a bull market, volatility increases. That usually indicates a top. You see a broadening pattern. If you've been through patterns of flash, you've seen that. But a broadening pattern is where the stock is swinging more and more from one top to the bottom, and that is usually an indication of a top. Just volatility in general usually indicates a top. You'll also see it at bottoms, but it just seems to be more evident when we're and when a bullish trend is coming to an end. So that's the question: is will it increase for 2026? Will volatility continue to go? And the other thing is, how do we adapt? I think one thing that's important that if you know the volatility is increasing, you know that it's a bigger factor in your trading, then if you find yourself getting stopped out a lot, then your stops are probably too tight. I know I thought that for quite a while. How am I going to do this? And then I went, okay, so if I actually loosen the stop up and reduce my size, so instead of, for example, instead of doing 10 contracts and having a $2 stop on it, I'll do 5 contracts with a $4 stop. So I have the same amount of risk, but I'm giving it more room to move around its support or resistance range. And that actually changed things a lot because your timing's never going to be right on. And that's what we always are looking. We want to get in and we want the stock to move in our favor instantly and just keep going forever, right? Just tank instantly or go up instantly, whatever side you're on, right? But it just doesn't happen that way. And it's very, very, very rare where you're going to catch the top or the bottom. In fact, you're a lot of times you're not going to be that close. So what I realized in my own trading was that I was putting my stop too tight and I get ticked out of it. My analysis was fine. I'd get ticked out of something because it was so tight and then it would turn and do exactly what I expected it to. So when I loosened up my stop, then I was giving it that room it needed to breathe and do its thing before it moved in the direction I was expecting it to. And when I realized that and I started doing it, that's when I started to become more consistent because I was expecting that, okay, it's not going to move that much. I'm going to, I want to get as much leverage as possible. I want to buy, get a huge position, biggest position I can, because if it moves, then I'm going to kill it, right? But what I discovered is that it was actually more profitable to loosen up the stop, cut the size, and give it room to breathe. So that changed things for me. But that's one thing you might need to do if you're expecting more volatility and we're expecting these stocks to move bigger, is you might need to adjust your trading plans to adapt for that. Okay, it's going to be more, that means we're going to have bigger intraday swings. The average true range for a lot of stocks has increased and will probably continue to increase if the volatility is increasing. So you've got to give it a little bit more room to breathe and do its thing. But it's not necessarily a good thing to increase your risk while doing that. So this might be a year to reduce the size and increase your stop range. And maybe it applies, maybe it doesn't. It just depends on how you're trading. Right? There's a million different ways to trade. It's unlimited. It's infinite ways to trade. And you got to do what works for you. Some people are scalping, others are doing, day trading, others are, swing trading, some people position trading, some people are long-term buy and hold. And maybe you're writing calls against stuff. Whatever you're doing, you gotta adapt your style to what's going on in the bigger market. So let's take a peek now at real estate. I think one thing, getting back to Tripp's comment, not only the demographic decline from immigration, but I think the demographics for the real estate is also partly the baby boom generation. Right, we got this huge baby boom generation who are either retired. My mom's a first year boomer, and about 2 or 3 years ago, I think the second half of the boomer generation started to hit retirement age, and a lot of them are retiring. And with the that massive spike, I mean, we're up 25%. We'll see here in a minute. I got a couple of charts with real estate, but um, with the huge increase in real estate, the wealth effect has taken a huge part. It's like, hey, I bought this house for $50,000 30 years ago. Now it's paid off, paid it off, and it's worth $500,000 now. So they feel wealthy because I have an asset that's worth 500,000. If I sell it for 500,000, I could bank 500,000. But then where are you going to go? Right? You got to live somewhere. Uh, but a lot of them are starting to downsize. Right? They have this big house they had with a family, and now they don't want. My parents are actually not shockingly. My dad just turned 83. My mom just turned 79, and they bought their house in 1984 just before my little sister came along, and now the stairs are getting hard for them. Uh, and it's, they've looked at elevators. My dad started talking 15 years ago about one of those little chairs that go up this, but their house was built a long time. Their stairs are not super wide. And my mom can't even take the laundry basket upstairs anymore. She has my dad do it. And he even said in the last year, he goes, I get halfway up the stairs. I got to stop and take a break. Like he's not excited about his lack of physical ability at 83, but he's compared it to a year or two ago where he still could do quite a bit. So as I mentioned before, he's a forester. So he goes out and he just told me over Christmas he ordered 100 trees because he's got this one property about 15 minutes away that's 40 acres, and they logged a bunch of it a couple years ago and replanted. And then because one of the hills is facing south, the sun hits it hard. So in the summertime when it's dry, these little trees, if they don't take up enough water during the wintertime, they don't survive. And he was out trying to water them and stuff to keep them alive. So he didn't have to replant them, but not all of them made it. So he said he ordered another 100 trees. He goes, I can't go out. He goes, last year, the year before, I could go out and knock those out in a day. He goes, now I plant 2 or 3 trees and I got to take a break. I'm like, well, I mean, you are 83. And the fact that you can even go out there and do that is impressive. Still, I mean, at 83. So, I mean, it's, and the hills are not, they're pretty steep. At least the hill, I know he's out because I grew up going out to that property. It's a pretty steep hill. So, um, but they're looking at retirement homes. And so, I mean, if it comes to that, they'll sell their house. But I know that it's already on their mind and they're already looking. They went and toured a place a few months ago. And they're at that generation where, they need to downsize. They need to get into somewhere like that. That's one of the reasons those big, those things are popping up. I call them old people homes. I don't know if that's not politically correct, but that's what they're for. They're for old people like my parents. I mean, I love them to death, but they're old people. So, and I'm right on their tails. I'm getting old. So, but they're popping up all over the place. And the question becomes, what happens to the real estate market when they start to sell their house? People like my parents in the next 5, 10, 20 years. And granted, I mean, that's a long term perspective. We're really kind of just looking at this year. But the real estate market has, as you can see, it has underperformed the last couple of years compared to other asset classes. But here's where it's interesting. And this is basically just the last year or so. Yeah, November 24 to 25. We went from a heavy sellers market in, well, 20, 21, 22, 23, basically 24. This is the months of supply. There were several different charts about inventory, real estate inventory. And some of them were just, there are a whole bunch of lines and it's convoluted. And it's like, I think this is the easiest one to look at is the months of inventory, months of supply. And it's been in a neutral market for the last, well, basically most of all of 2025. And I think it's actually getting more and more to be a buyer's market because people are trying to sell and they don't, I think most people don't realize that the valuations are not what they were a year or two ago. So we're slow to react, right? We get anchored. There's the anchoring bias where we anchor our belief in, hey, a year ago, our house was worth $500,000. So it's still worth $500,000 today, but it might only be worth 450. And I talked with my neighbor quite a bit. She's an agent. She had a gal just a few months ago was selling her condo. And she bought it back in 20 or 21. Oh, I need 385 or whatever the number was. I need to sell for 355 or something like that. And she's like, well, honestly, looking at the valuations, I'm in the market. I think 325 is a reasonable price. You can sell it quick. You get rid of it. No, I need 355 because that's what she owed on it. She didn't want to lose money. It's like, all right. She said, well, if you wanted to sell at that higher price, you're going to have to do some upgrades. You're going to have to replace the carpet. You're going to have to do this. And then she was really irritated with me or with her client because so she puts $5,000 of carpet into it. And then she called, we need to raise the price to 360. I need to get my $5,000 back. She's like, they ended up selling it. I can't remember what they got for it, but they got rid of it. So obviously somebody was there for it, but it shifted the market. And in today's market with technology the way it is, things move a lot faster than they used to. Even real estate, which used to be the super slow market, it still is relative to stock market. But things shift and change a lot quicker than they used to. That's another reason that as traders, we need to be significantly more nimble than we used to be because things will shift quickly. And if you get some kind of black swan event or something happens and people can sell off just like that. 20 years ago when I started, there was very little online trading. Today, the bulk of trading is online. And I don't know how much algorithmic trading there was back then. I know some of it was taking place. The people that the big money hedge funds, the big money people that had literally millions of dollars to buy expensive computers. But now that's all that cost has come down. Now the average Joe can do it. Something like 70 or 80% of the market is traded algorithmically. So it's all just machines trading it. It's algorithms saying if this happens, this happens, this happens, then go buy this or sell that. So when shifts in the market come with I don't know if I'd say advent, but with the use of technology, it makes the swings significantly faster than they used to be. And that's now even applicable in real estate. So you thought a year ago your house was worth $500,000. You think you can get $500,000 for it today, and you can't. So a lot of people have posted or they've listed their homes with a mindset of last year. This is what it was worth last year, and it's still worth that this year. And it's not. It's changed. So the whole real estate industry has changed quite a bit. So we'll see how it plays out. But it is we're in essentially a neutral market right now. But again, I think that's going to change. I don't think that's going to keep up. but we'll see. We'll see. Well, here's an interesting one: is listing cancellations. And this goes all the way back to March of 17. And you can see from March of 17 all the way up to June of 22, right in there, those two little spikes are that's COVID, right? So when COVID happened, that makes sense. If you listed your house during COVID, you cancel it because nobody knew what the heck was going on. And everybody locked down, so you can't even go look at houses. But it's been pretty steady, between about 10 and 12%. It's probably the average there is probably about 11%. Well, in June of 22, we got that spike, that blue bar right there. And now we have, since June of 22, we have averaged right around 14% as far as how many sales fall out of contract. So people that list the house, they maybe have an offer, and then for whatever reason, the person that put the offer in cancels it. Or the sellers could back out. There's lots of reasons that it can happen. But why do we have this 3 percentage point spike? I mean, that's basically a 25, 30% increase. Have you got an average of 11% back here for 4 or 5 years? Then you go to an average of 14%. That's a 3% increase. But 3% of 11% is basically 33%, 30%, let's call it. So the last 3 or 4 years in real estate has seen big numbers of cancellation. I mean, we're on par with the COVID cancellations, which may or may not mean anything. It just means that buyers are backing out or sellers are backing out for whatever reason. Excuse me. Cough's almost gone. Yeah, I just saw your comment there, Triv. Yeah, boomers are moving out to houses, condos, independent living facilities. They're popping up everywhere around here. There's one about 2 years ago. There's one just a few, I don't know, half a mile or a mile from me. Another one. I mean, I've seen 3 or 4 pop up just the last couple of years. So, yeah, exactly. That's the other thing. I've been mentioning that for 5, 10 years now because the boomer generation is huge, right? And they own, like I said, 60% of their investments or 60% of the market is boomer money. So when they start to draw out, my mom's got a pension for being a teacher, but uh, my dad's got money in the market. I know he has to draw a certain amount every month. He's had to for a decade or 15 years. I don't know how long. Um, but as they draw on it, will there be enough capital to replace it? Is the question. And maybe they will, maybe they won't. A lot of it depends on things. Well, here's the other crazy thing. And this is where I've started to shift over the last 2 or 3 months to maybe we'll be bullish in 26. I don't think we will. I think we're going to be sideways at best. I think we're probably going to have a retracement. The question is how big, how fast, don't know. But we have a huge tax cut coming. There's about 150 billion dollars of tax refunds that are going to come back into the economy, which is mostly just kind of pocket change for a lot of people. It's not something you're putting a down payment on a house for with. But for some people, will it'll be enough to where it'll maybe boost their savings to where they can buy a house. But with the taxes going down for almost everybody, that will create economic activity. Will it kick into place right away? No. I think the first half of the year is going to be. I think we're going to pull back in the first half of the year, and then it's probably going to kick back in. I would think, and we'll have people have more cash. Get less taxes means you have more spending money. You have more spending money. That means you go out and spend it in the economy. It's just the nature of the beast. So, but here is this one's a little bit backdated. I'm not sure where I pulled all these this morning. So they were, but this is only up to 23. But you can see here in 2020, the spike in real estate. This is the Case-Shiller home price index, year over year change. So it shows the prices year over year. Well, right there's the spike of 2020. You can see the left side is '07, right? That's the housing crash where we dropped 28% or 20%. And then, well, nationally, it was only 12 or 13%, but 20 major cities, 10 major cities, that's what the blue, you can see the little thing there. But a pretty significant drop in real estate overall. Rallied back, came back up, and in 2020, the real estate spiked, went crazy, right? And then late 22 into early 23, they dropped back off to the flat line where they're not increasing anymore. They're just sitting there. I don't know where we're at now. I'm not sure. I guess I should have gone and looked to see where it was, but you can see, I mean, prices correct all the time. And you see here in 2012, it rallied way up and then it sold back off, rallied way up, sold back off, and then it kind of flatlined, which this is a 4 or 5%. Theoretically, a 3 or 4 or 5 or 6% increase in real estate is kind of a natural flow thing. So you can see here, that's what we've got. 2015 to 2020 was a about 5% on average, maybe four, if you take this little dip here. But it should realistically be a pretty steady flat line. But we haven't had that the last 20, 15, 20 years. It's been relatively volatile, and real estate is not naturally volatile, not like stocks are. But here's the Zillow home value index going back to 2000. You see back January of 2000, the average, I think it's average or median, mean, I mean. This is adjusted for CPI too, indexed to 82 to 84. Okay. So this is inflation adjusted essentially. But you had 267 rallied all over in '06 it peaked out, right? And then you had the housing crash. So there's a recession. That gray bar is a recession. Then we bottomed out in 2012, rallied up, and then you can see the spike. There's 2020, right? There's the COVID crash, that little thin gray bar. That's the recession. That's the Great Recession in '08, right? That was what, 3 or 4 quarters worth? You got there's the recession of 2000 after the dot-com bubble. But then we have the COVID recession, and look at it. Just here, you have a gradual. Well, it's not necessarily. It's more parabolic, right? Back in '02, when the real estate market took off, it was pretty parabolic, but it got really steep. Here with COVID, it's just a straight shot. It's linear. It's just straight up, which is not normal, right? Excuse me. So we've had a normal pullback, which we should, and realistically, we probably should come back down, I would think, into this area. If you, I don't know where the median line would be, but it should be right in about 335, give or take a little bit. But again, that's based on Zillow. This is the one that I find really interesting. There you go, Brenda. You happy? She's just sitting hanging out for you too. That's the Maine Coon. She's my favorite. Huh. She's chill, mellow, really cool. She's very dog-like, which I like to have a dog. I just don't have time. But this is the real estate, and again, this is inflation adjusted. And you see, this is going all the way back to 1890. And you got 1920. There's 1920, the Great Depression. Let me grab the pen so I can mark on this and you can see what I'm talking about. Right. So there's the 1920, right? You see the big giant drop off. Um, which interestingly enough was not, I guess that's actually, it's hard to tell where that is. It looks more like it's 1915. Because yeah, 29 is not till here. We had the Great Depression. Then the stock crash. There was actually, and a lot of people don't know that, is that there was a Great Depression in the teens, the late teens, maybe early 20s. I don't remember what it was. It was a depression is 6 quarters of negative growth. So I think it was like 1917, 18 or something like that. Or maybe it might have been 1918, 1920, something like that. There was a depression. There's over 6 quarters of negative growth. And then Coolidge, I think it was Coolidge, if I remember right, came in and he cut taxes in half, cut regulations. He cut all the government fat, just axed it all out. That's what gave us the roaring 20s. Is that there was money to invest. Taxes were cut in half, regulation was cut in half. All the stuff the government was doing the government got out of the way. The private sector went crazy. That's why we had the roaring 20s. But that also led to the next depression because they had no guardrails in on trading. Everybody was getting rich. People just threw money. Of course, they had margin of 10 to 1, right? The margin requirements was 10%. So you could put $1,000 in an account and have $10,000 of buying power. But if you only put 10% of the money in, guess what happens if the stock moves 10%? All your money's gone and you're going to get liquidated. That's what caused the Great Depression. Well, I take that back. Clarify. That's what caused the crash. What caused the crash was margin calls. Because when you're that highly leveraged and it goes against you, you're toast. That's just bad. And that's what caused all of it. All margin calls just crash the market. Um, the Great Depression was caused by government intervention, in my opinion. So, but if the government just get out of the way, then leave us alone and let us do our thing, then kill it, which I think is what's happening. That's why I think this year is going to be a little slow in the beginning, but I think once the lack of regulation and the smaller taxes, I think that's going to eventually kick in and the economy, I think, will boom. But at the same time, we got, this huge, here's the '06 bubble. And again, this is inflation adjusted prices. So, I mean, here's the 40s and 50s, which was killer. Then the 70s and 80s, stagflation and all that stuff, that was kind of just flatlined. But then in the late 90s, right when the stock market boomed, so did housing prices. And boom, we come up to '06, we have the bubble, major correction. Interestingly enough, right back to the old resistance, right? If we treat it as a stock chart. But here we are with valuations at all-time highs. And is it bubble? Possibly. I think it just depends. There's a lot of factors that can change that, obviously, but it's hard to say. But are they too high? Yeah. Yeah. Valuations need to come down, or interest rates need to go up or down, excuse me. But, and this is another thing I keep an eye on is, and we got futures here, but also have the 10-year, which is right there, which is 418. This is what most mortgages are based off of. When you hear somebody say, "Oh, the Fed's going to cut rates, so that's going to make mortgages cheaper." The Fed rate and the bond rates aren't directly correlated. They oftentimes are, but not always. I have to say, be careful. In 2024, it's not last year because last year was just 25. In 24, when the Fed cut rates by a point, bond rates went up by a point. People are like, wait, what? Yeah, the Fed cut rates. Bond rates are based on risk. And bond traders are looking at it going, well, how much risk am I going to take? How much risk do I have on that 10-year? The 10-year and the 30-year are the two that matter. And there's the 30-year. I had it. Where did it go? Right there, 40, 48.64. So rates are 486. You just move the decimal point by one. It's not something I mean, I just look at it, I just glance at it and don't look at it that close. But here's the interesting thing is here's the 10-year yield, right? And the yield and the value of the bond are inverted. Excuse me. So if you go look at the actual bond itself, it's the opposite of this. But anybody see anything there? That bottom was the daily chart. You ignore the top one. Actually, let me make that bigger real quick. Holy cow, we're almost 10 already. Um, y'all see that pattern? There's an inverted head and shoulders right there. So bond yields have been dropping off. Well, let's see if we can get a little more data there. Oh, that is maxed out. I don't know if we can. I won't. That's good. Um, let's go to weekly. See what it looks like. I don't like that. I guess that gave us a little more time. Back to no, that's back to January of last year. Only got a year's worth. That's a year's worth of data. But that's a 10-year. You can see the yield's been dropping off. And these are weekly charts. But we'll go back to the daily. If we get back to this 480 level, the housing market's going to grind to an almost halt. I mean, it's 420 right now. If it goes up 60 basis points, that's a 15% increase. So if it breaks north of 420, then I have little doubt it's going to go higher. So, and a lot of that is government spending because bond traders looking at it going, the government's not cutting back. They're still spending. They're still running a deficit. Once they stop running a deficit, and if the money into the coffers, if the U.S. becomes less risky to invest in, then bonds will go up and yields will come down. But that takes us to this, and we're going to wrap up with this. Now I know why that coffee's cold. It's been an hour. All right, see you, Brenda. Happy New Year. Bond auctions have stunk the last couple of times. Exactly. Yeah. Well, the central bank, right? And this is the third topic we're going to touch on here is that they've essentially, I mean, Jay Powell came out and said it without saying it, that QE is back on. They're buying up $40 billion of bonds every month for what? Which makes you question. And that's if you're going to trade long term, you got to stop and question things. You can't just blindly go along with whatever you hear. Why are they buying up $40 billion of bonds every month? But nobody wants them. That's the only way they can keep the interest rates low. If they buy the bonds, they'll keep the price of the bonds elevated, which keeps the interest rates down, keeps the yields low. That's why this what they did in QE. It's buying up billions and billions and billions of dollars of bonds. Um, but if they increase liquidity, they put more money, pump more money into the system, that devalues our purchasing power of the dollar. Hence the reason gold has been going crazy and silver and alternatives. I mean, Bitcoin. I'm not a big believer in Bitcoin, but some people believe in it. I think it could be a good trading vehicle. I don't believe it's an asset. Some people call it that, but whatever. um, so why are they doing it? Because inflation's not where at their target level. Unemployment's still relatively low. So why did they cut again? And why are they reinstituting QE? Because they are, even though they didn't say it, because that would have freaked the market out. Excuse me. That drives me nuts why people come out and say, well, how come Trump doesn't just come out and say this? Or Jay Powell just doesn't come out and say that. Trump can't come out and be honest. I have no doubt he sees what's going on in the economy. He knows that there's a risk that the market could tank. He knows there's a risk that that could happen. He's not stupid. He's been in real estate his whole life. I mean, he's my mom's age. He's 79, almost 80. And I think that's what he's been railing on Powell for is Powell's going to be the scapegoat. If the economy tanks, which I don't know if it will tank or not, but I think it's definitely going to retrace, then he can say, look, Powell didn't reduce rates. You call him too late. It's politics, which I don't like. I'm not a fan of that, the politicking part of it. But is Jay Powell, I think maybe he's in a tough spot. And that's the other thing. He can't come out and say, yeah, we're quantitative easing. He can't tell you the truth. He has to parse words. He has to dance around it. Because if he comes out and tells the truth and says, yeah, we see the economy getting really, really bad the next 6 months, what's going to happen? Later, market goes down. Same thing with Trump. Anybody in that position, if they come out and publicly say it, I mean, Scott Bessent comes out and says, yeah, oh, we're seeing lots of weakness in the economy. They can't. They have to be a cheerleader. I don't, like I said, I don't like it. I wish they could come out and be honest, but they can't because people will panic and freak out. So you got to remember that when you're listening to people, the question is, what position are they in? What can they say realistically? And what's the motivating factor for them saying what they're saying? I mean, obviously, Trump wants people to believe that the economy is great, even though I don't think it's that spectacular. I mean, in my world, I'm okay. But I know lots of people that have gotten laid off. My brother got laid off, then he got rehired back in a different role, but he's taken a pay cut. I don't know how big it is. He didn't say, and I don't care. But a lot of people are in that position. The tech world's like that. I just saw an article yesterday about the tech world and how it's getting in Seattle, especially. Seattle is a huge tech hub, and the layoffs are starting to take hold. Excuse me. So yeah, the question is how deep do those cuts get, and how much of an impact does it have on the economy overall? And it's already because a lot of people are getting same thing my brother had, where they get laid off their job, but then they bring them back at a position that's lower. They're not making as much, so they have to cut back on their spending. They don't have to, but a lot of them are making, at least in the Seattle area. I mean, they're making two, three, four, $500,000 a year. So they get a 20% pay cut, but it's still a pay cut, right? It still impacts that wealth effect. Like I was making a half a million last year. Now I'm only making 400,000. I'm still living comfortably, but there's 100 grand that I don't have extra now. So the question is, what happens if the Fed continues QE? Does that kick inflation back into gear? I don't think it will, actually. Believe it or not, I don't think it will. I think the people leaving the country is having an impact already on rents, and it will have an impact on housing prices, obviously, because if you lose your house, which a lot of people are, foreclosures have ticked up. That's one thing I didn't put in the real estate part, but maybe I should have. But if foreclosures tick up, which they've ticked up quite a bit actually, then that's going to increase housing supply, which will bring down valuations. If interest rates continue to climb, that'll make it even tighter. So there's a lot of different things that could happen. The reality is none of us know, right? None of us know exactly what will happen. Here's the last thing I just realized, like how it's 5 after. There's the human factor that we have. We all have it, right? Markets aren't perfect. There's the efficient hypothesis theory that the markets are efficient and they find the right price, which is, I think there's some truth to that. I think this one's a little bit better. Andrew Lowe's adaptive market hypothesis. They are at times markets are very efficient, and other times they are not. Human emotion makes things wild and crazy, right? You got FOMO and fear, but the beauty is that you'll have periods of efficient times, and then you have periods of inefficient times where the market can't figure out where it should be. When markets tank and people panic and people freak out, they don't make wise decisions, right? That creates an inefficient market where things are just wild and crazy. Volatility could be considered an inefficient period. But those are the periods that create opportunity. So some people are like, you're always talking so negative. The market's going to crash. And it's like, I don't know if it's going to crash. I think it's going to retrace. But to me, it doesn't matter. As a trader, I don't care. Just move. Don't just sit there. As long as you're moving, then I'm content. Preferably the direction I want you to go. Right? But if not, I'm going to get stopped out and I'm out. And I'm usually out pretty quick if I do get stopped out. But the beauty is that in the position that we're in as traders, we don't have to worry about which way the market's going. We don't need it to only go up to make money. But if you are just a bull and you don't want to trade the downside, which is fine, then you should at least know when to stay out of the way. So at least if you know when to stay out of the way and stay out of a potential falling market, or how to protect yourself if you hedge. I was looking, my neighbor doesn't know anything about the market. He's alluded to a few times about wanting to learn. A couple of them did. This guy over here wants to trade. He's played with Bitcoin and stuff. I'm like, whatever. But my neighbor, the one I'm good friends with, we're hanging out all the time. And he's like, can you help me learn stuff? Yeah, absolutely. And so I went and looked up Netflix just out of curiosity. I go, let me give him something simple because he knows nothing about the financial markets and he really doesn't want to. He does, but it's not a big enough driver. So I went and looked at a few big names: Netflix, Microsoft, Nvidia, some of the big companies that are solid. Netflix was 93 and change when I looked at it. Yeah, it's 91 now. I was right at 95. And I'm looking at it going, you can buy the stock at 95 and also buy the $80 puts for January of 27, so a year out. So buy an insurance policy a year out and sell the 125s for seven. You could buy the 80s for $7. You could sell the 125s for $7, right? So you didn't have any money out of pocket. Buy the stock at 95. You got an insurance policy at 80. You're going to sell it above 125. $15 of risk, $30 of profit potential. And that was just a simple, like, here's what, if the market goes down, then here's the beauty though. Here's what I was thinking is, okay, because he doesn't know anything, trying to keep it simple for him. If, let's say the market does crash, Netflix goes all the way to $40. You have the $80 insurance policy, you cash that in and you take that money, right? You have $40 of intrinsic value. You take that $40 and buy the stock. So now you just double up your position. Now you have twice as much stock. Yeah, you're upside down technically 15 grand, maybe 20, whatever. But you have double the amount of stock. So even if it runs back up to 50, you're profitable. Anyway, I don't remember why I brought that up. Just adapt your trading. Oh, because if you're a bull, if you're only a bull, that's all you need. That's one way you can do it. You can have your long positions, but then hedge them on the downside. So if things do crash, you can either cash in your insurance policy and just take the cash, or you can buy more of the stock that you want. If you like the stock and you think long term it's going to go higher, then buy an insurance policy, sell a call way up here. If it does tank, cash it in and go buy some more. And then if things do run back again, which I think they will, guess what? Now you have a bigger position, which means you're more profitable. Anyway, I think that's it. Oh, nope. Quick finish up. Respect the cycles. Prepare for volatility. We're already in a volatile environment, right? Just adapt. Should probably say adapt for volatility. The Fed, I mean, you watch the Fed, obviously you can't do anything about it. You just have to adapt to what they do. Systematize. That's the biggest thing. You've got to figure out how to manage your emotional risk. Is how to stay out of the way when things go bad, or how to protect yourself when things do go down. You got to trading is about managing your emotions. That's the bulk of it. The math, the numbers, the charts, the analyzing charts, and all that stuff. That's pretty static. The challenge to trading is managing your emotions and managing them well. And then AI can really help. Not only can you do a lot of research. I mean, a lot of the stuff I pulled up just this morning on AI. I just went to Grok and said, I need some data on real estate for this and this and this. Then it gave me this whole thing. If you want charts, let me know. Yeah, I want some charts. So it pulled those charts. So there could be there's a lot of benefits to AI, even though it's still kind of it's not that spectacular yet. It'll get a lot better. It's still good enough to where you can do a lot of research and make things a lot easier. And just ask it things that you need. Just say, hey, I need this and this and this. How do I do it? And it'll show you. It's pretty crazy. It's pretty awesome. But anyway, any quick questions? How not to be frustrated? How come Caterpillar's up 4%? Do they have earnings or something? They're up 22 bucks. Huh. I don't know. I just happened to notice that. All right. Well, thanks for coming and hanging out and having some fun. If you have any questions, we'll see you on the next go around 3 or 4 weeks from now. So you'll have a great new year and trade well. Have fun, and we'll see you very soon. God bless. Bye.